Hi, welcome back to my channel. My name's Sarah Irons. I'm a mortgage broker and my channel is for mortgage information and tips, not advice, for all of you to help you achieve your property goals wherever you may be in your journey. I am in the middle of my first series, which is called the Residential Home Back to Basics. Within this series, I have 12 mini episodes. There'll be something for everyone to learn. And this episode is about debts. So what debts do you have? Is that going to affect your mortgage? Is it going to affect the amount you can borrow? I just intend to go through that with you, and hopefully you will gain some information that might help you organise your debts or have a bit more of a steer on how that's going to limit that loan size that you can get. So if that's something you'll find useful, keep watching. Debts, dreaded debts. Most people have debts. Please don't worry, please don't be embarrassed. Please tell us everything that you've got, most important thing. So while we're doing a fact find, which is normally at the start of the process, we will complete a fact find, which is you giving us information about you, quite personal information, obviously all financial, banking, mortgage, debts, etc, etc. Debts is a key part because if you don't tell your broker the true extent of the debts, maybe you think actually you'll pay that off before the application, or you know, somebody's going to give you a gift for it, or you've got every intention of it not being there at the end of your mortgage application. That's fine, and I understand why you might not actually tell your broker about it. However, even if you were to pay it off at the end of that month, for example, it might take another month, sometimes 4 to 6 weeks, before all the credit scoring agencies, so Experian, Equifax, Cool Credit, they update their systems only monthly. So when we do a mortgage application, there is something called non-disclosure. If we don't disclose a debt that you have, even if you have actually paid it off, but it's still showing as a debt because a month hasn't gone by since you paid it off and therefore it hasn't updated itself, then it will bounce back as a refer, or we'll get an inaccurate agreement in principle, or maybe even a decline because we haven't disclosed some debt that you've got. So it just causes a problem right from the get-go. So really, really important, no matter what debts you've got, if you've paid some off before you speak to your broker, but you haven't done it, you've only done it maybe a month ago or anything less than 2 months ago, it's very, very likely to still be showing up on your credit report. So please declare everything. And by all means, tell your broker that you have actually paid that off, but it might still show up. So that's definitely the first tip. Okay, so how do lenders view debt? Okay, so strangely, but it's true, credit card debt won't really make that much of an impact on the loan size that you can get. There is a caveat to that, and that is that there's something called a debt to income ratio. So if you earn £30,000 a year, but you have more than £15,000 worth of debt, that would be a 50% debt to income ratio. So your debt equates to half of your annual salary. This is normally about where the lenders get a little bit twitchy, so bear that in mind. So some lenders don't have a debt to income ratio and some do. Sometimes this is more prevalent on a buy-to-let application as well, rather than a residential, because residential uses affordability. So as long as your income can support those debts, then they're not too worried about it. I'll go into that in a second. So credit cards, the lender will normally typically take 3% as your monthly payment. So 3% of the credit card debt, that's what they're going to factor in as the monthly payment. Even if your credit cards are 0%, or even if it's 18%, they're going to use 3%. So that can benefit you or hinder you. However, 9 times out of 10, people's credit card debt doesn't really affect the loan size that you can get. Loans, on the other hand, so unsecured loans, in other words, not secured on the house, so just a home improvement loan, a loan that you might have got from the bank for something that you wanted, these really do affect the amount you can borrow. It's the monthly payment. They're normally very high because they're on repayment, sometimes over 5 years, sometimes longer. So the monthly payment on a loan is quite high and it's set in stone, so you really have to pay that monthly payment. Whereas obviously with a credit card you have a minimum payment, and it's just interest. So they work very differently. If you had a couple of loans and you were spending, you know, sort of £500-600 a month on a loan payment, that will drastically reduce the amount of the level of borrowing that you can get when you're applying for your mortgage. If you have a loan in the version of a hire purchase agreement or lease agreement on a car, again, that debt does need to be factored in, and it can reduce that loan amount for the same reason, because you are sort of tied into paying that quite high amount each month. It doesn't have as much of an effect just because of the way that some HP and various sort of car leasing agreements work. So sometimes there's a balloon payment, or there isn't actually an actual debt because it's more like a rental agreement that you've got, but it definitely will impact the loan size if you've got one of those or more. So that's also something to bear in mind. If you are planning to repay the debt on completion and you want the lender to ignore that debt because of it, there are lenders that will do that. And that's the end of it. You tell them you're repaying it, that's fine. There are lenders that will do it, but they will ask for proof before completion. So they'll want statements to show that it's been paid off, or they might ask the solicitor as a caveat to the offer to make sure that they've seen a statement to show that it's been paid off. And there are some lenders that, despite you telling them you're going to pay it off, they err on the side of caution and they include it anyway, because they have to trust you that you're going to pay it off, or you could simply pay it off and take it straight back out again the day after. So bear that in mind as well. So if you have got some debts and you are going to pay them off by completion, make sure you speak to your broker about that. And if it's not going to be done on completion but soon after, there are lenders that, you know, will be happy with that. So definitely have a word with your broker, because they'll know the lenders that will suit you best on that. So yeah, that pretty much summarises debt. So depending on what type you have will sort of depend on the impact of the loan size. So if you were thinking of taking out some sort of car lease, or HP or loan for a car, for example, just before you apply for a mortgage, I would wait. I would do the mortgage first, get that affordability done, and then you can consider that in the future if that's still affordable once you've got your new mortgage in place. Plus it's a credit check, and you don't want too many credit checks when you're about to apply for a mortgage. But yeah, in summary, that's debts and how they can affect your loan size. Any questions, leave them below. If I've missed something, then, you know, please, I'll come back to you. Or if you've got, you know, any questions, let me know. And yeah, this is for you. This is for me to help you. This is your channel. You tell me what you want to see, or ask me any questions, and I am happy to help you. So I hope that's helped, and I look forward to seeing you in my next episode. Bye.